David Macdonald, senior economist at the Canadian Centre for Policy Alternatives. David, good to see you. What do you make of today's slight increase in jobs numbers? Is it in line with your expectations?
Well, we're seeing the continuation of this trend that we've seen going on since really January of 2023, this very slow increase in the unemployment rate. We were at 5% in January of 2023. We're now slowly ticking up to 6.2%. This year's gain of 27,000 jobs in the aggregate masks a big change between full-time and part-time work. So during this period, we actually lost 35,000 full-time jobs, but gained over 60,000 part-time jobs. What that means is that the involuntary part-time rate, so the proportion of people that are working part-time but really don't want to work part-time, they prefer to work full-time, has really jumped a lot in this May compared to last May. So it does continue to signal this underlying weakness in the labor market. Over the last year, there's been about 650,000 new people looking for work in Canada, and about 400,000 of them have found work. That's positive, but again, because of that gap, we're continuing to see the unemployment rate creep up.
What does this all tell us about wage growth and the strength of the economy right now?
Yeah, so wage growth in this May versus last May was up 5.1%. This is now the 16th month in a row that hourly wage growth has exceeded inflation. In contrast to the previous 2 years where inflation was far higher than hourly wage growth, and so workers were sort of falling behind. At this point, for workers, one of the solutions to the affordability crisis and higher prices is ask for a raise. And so hopefully if you make more money, you can afford to pay the higher prices at the grocery store, for instance. For full-time workers, they are close to fully clawing their way back to inflation-adjusted wages as they existed in 2021 prior to this big uptick in prices. Full-time workers, not so much. They're still about $1 behind where they were in 2021 in terms of their purchasing power and real wages. And so workers are continuing to claw their way back, but they have not yet clawed all the way back so they can buy the same basket of goods and services as they could in 2021 prior to this big increase in prices.
Now, we had that long-awaited key rate cut this week from the Bank of Canada. What could these numbers mean for interest rates going forward?
Yeah, so this data is from mid-May, and so it wouldn't be affected by this rate change that we saw on Wednesday. Certainly one of the industries that we saw particular weakness in terms of job creation, or job loss rather, was the construction industry. This is one of the impacts of higher interest rates, is it impacts the residential housing investment, which is to say developers just aren't going to build as much in a high interest rate environment, not sure if they can sell the houses, but also their own costs to carry those houses over time while they're building them is higher. And so this is possibly one of those impacts of interest rates. The interest rate decline was relatively small on Wednesday, 0.25%. And its lag effects, the lag times are quite long. And so it takes a long time for changes in the overnight rate to have an impact on the economy, to have an impact on jobs and so on, in the neighborhood of 1 to 2 years. And so I wouldn't expect any immediate impact of the rate change on the unemployment picture.